Imagine this. You wake up tomorrow morning, you check your bank account, and suddenly your money is worth 5% less than yesterday. You didn't spend it, you didn't lose it, but somehow it's gone. This isn't science fiction. This is exactly what inflation does every year. And the scariest part, most people never notice it happening because the number in their bank account stays the same. But the power of that number slowly disappears. Today, we're breaking down the $0 savings trap and why millions of Americans are unknowingly stuck inside it.
For decades, Americans were taught something simple. If you want to be financially secure, save money, put it in the bank, build an emergency fund, and wait. But what most people don't realize is that the modern banking system changed. Your bank account feels safe, but financially, it's often the slowest way to build wealth. Because the system rewards investment, not storage.
Let's run a simple experiment. Two people each save $10,000. Person A puts the money into a traditional savings account. Person B puts the money into assets that grow with the economy. After 10 years, Person A still has roughly $10,000, but inflation might have reduced its buying power to $7,000. Meanwhile, Person B's investments could grow to $18,000 or more. Same starting point, completely different outcome. The difference wasn't income, it was strategy. Inflation doesn't hit everything equally. Some things rise slowly. Others explode. Housing, healthcare, education. These are the biggest expenses for most Americans. And these costs have been rising faster than wages for decades, which means the average household feels poorer, even if their salary increases slightly. That's why many people feel like they're running on a treadmill, working harder, but never getting ahead. Banks love savers, not because they want to help you, but because your savings power their entire business. When you deposit money, the bank can lend out a large portion of it. For example, mortgage loans, auto loans, credit cards, and these loans often charge 7 to 20% interest, but the bank might only pay you 0.1%. That difference is called the spread, and it's one of the most profitable business models in the world. So why don't people move their money? Because savings accounts trigger a powerful emotion: security. Seeing cash in the bank feels comforting. But comfort can sometimes become complacency. The wealthy think differently. They don't ask, how safe is my money? They ask, how productive is my money?
Think of personal finance as a ladder. Level 1, cash savings. Level 2, high-yield accounts. Level 3, stock market investments. Level 4, real estate. Level 5, business ownership. Each level increases risk slightly, but it also increases potential growth. The biggest mistake people make is staying on level 1 forever. Step 1 is upgrading your savings. High-yield savings accounts offer 4 to 5% interest in many cases. These accounts are usually offered by online banks because they have lower overhead costs. This means they can pay customers higher interest. It's one of the easiest financial upgrades anyone can make. Next comes the backbone of modern investing: index funds. Instead of trying to pick winning stocks, index funds invest in entire markets. For example, S&P 500 index funds track the largest companies in America. Over long periods of time, the US stock market has historically returned around 7 to 10% annually. That's why many retirement accounts, like 401k plans and Roth IRAs, rely heavily on index funds. They're simple, diversified, and powerful over time. Real estate has been one of the most consistent wealth builders in American history, but buying property requires huge capital. That's why many investors start with REITs. These funds allow you to invest in large property portfolios. You earn dividends from rent income without dealing with tenants or repairs. Finally comes the hedge:
assets that protect against currency weakness. Gold has been used for thousands of years. Bitcoin is the modern digital version. Some investors also diversify into international markets. The idea is simple. Don't rely on one single system. Spread risk across multiple economies and asset types. The most powerful force in finance isn't income. It's compounding. Small returns, repeated for many years, create massive outcomes. Someone investing $500 per month for 30 years could accumulate hundreds of thousands of dollars, not through luck, but through time and consistency.
The real danger isn't making bad investments. It's doing nothing at all. Because when money sits still, the world keeps moving. Prices rise, assets grow, opportunities compound, and those who participate in the system gradually pull ahead.
Saving money is still important, but in 2026, saving alone isn't enough. The new goal is simple. Make every dollar work. Because wealth isn't built by storing money. It's built by deploying money intelligently. If you want more deep dive breakdowns about money, investing, and the economy, subscribe to the channel. Because every week we decode how wealth actually works. And if you want to start tracking your finances today, download the free wealth tracker in the description. Your future self will thank you.